Good morning. Welcome to Stock Market Today for Thursday, August 15th, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Follow along with this show. Get daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. So another ugly day yesterday. U.S. equities sold off in Wednesday's trading, finishing near the worst levels of the day. S&P 500 finished with the second biggest percentage decline of the year. All sectors finished lower on the day, but the bond proxies outperformed. Energy and financials led to the downside. Treasuries rallied across the curve with the much reported 210 spread inverting for the first time since 2007. Dollar was weaker against the yen, but stronger on the euro. Gold continues to be a safe haven bid, up 90 basis points, and WTI crude was down 3.3% on the day. So your outperformers, utilities, REITs, staples, and healthcare, very defensive in nature. Underperformers, energy, fins, followed by materials and discretionary, as well as tech. And as we get to the desk this morning, futures are down 30 basis points. Asian equities were mostly lower overnight. European markets are weaker, and treasuries are extending their recent rally with the 30-year bond below 2% for the first time ever. The dollar is weaker versus both the yen and the euro. Gold is adding on, up 20 basis points, and WTI crude is down another 2% to get things going on a Thursday. So here, the S&P 500 is now fallen into the support zone that we've been identifying. We've been calling 2,800 to 2,850 support. We closed at 2,840 yesterday. Now, what's important to me is that we so far have held Monday's lows. Now, we're under pressure here again this morning. You do have that support. Stronger support is really down around 2,800. And you also have the rising long-term trend line continuing to move in that direction as well. 200-day moving average. It's at 2795 and likely going to tick closer to 2800 over the next couple of days. Resistance is in the area between 2950 and 3000 for strong resistance. But realistically, now we have to start thinking about the area around 2900 as well. RSI remains below 50. So that is now starting to play out in a bit of a shift to bearish ranges. We'll see. What would be encouraging to me now would be to hold in this support zone and have the RSI not become oversold. That would be encouraging. I'm not saying it's going to happen, but it's something that we would be keeping an eye out for. Chaikin money flow is bullish, but declining as you would expect. I mean, we've had a few days here where we've closed near the lows. That's going to have a negative impact on Chaikin money flow. So indicators are still mixed. We're in the support zone. Futures are under pressure this morning. Want to see now how the market reacts if we get down to around that 2,800/2795 200-day moving average area. Your market in a minute. What are we talking about in the note today to Chaikin Analytics clients? 210 yield curve inverts. Should investors panic now? We'll take a look. Stocks decline on fears of a recession and slowing global growth. That's been the story for a while. As yields fall, dividend-paying stocks have potential to outperform. We'll take a look at an interesting ETF. Breadth weakens with the index, but signs of a short-term reprieve. Futures do point, as we said, to a lower open here today. So it's downright ugly from a power bar perspective, all now in skewed to the bearish side. Take a look at the Dow. Down 3% yesterday, 0 bulls, 10 bears. S&P 500 down 2.9%, nearly 2-to-1 bears to bulls at 119 to 60. NASDAQ down nearly 3%, also nearly 2-to-1 bears to bulls, 29 to 15. Small caps actually a small outperformer yesterday, but the power bar ratio turns bearish. 393 bears, 314 bulls. Big uptick in bonds once again, sending yields lower. That's a story that we've been all over. For those of you who subscribe to my market survival guide, you know that we have been bullish treasuries. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. Major indexes are mixed, but they're bearish. Stock of the day today, auto-generated by our algorithm, PJT Partners from the Finance Group. Down 3.6% yesterday to close at 39.42, but the power gauge rating is very bullish due to very attractive financial metrics, very positive expert activity, as well as strong price volume activity. When we take the 20 factors, 5 in each of these 4 categories, we come out with our very bullish rating. But we have a stock here that's trying to make a turnaround, right? Downtrend, now trying to stabilize, right? Very bullish rating, however, is met with a massively underperforming stock. It's been an underperformer for nearly a year. So the power gauge rating is bullish, but we're underperforming. So right away, we know that that's a stock we don't want any part of for the time being. Overbought, oversold indicator rounding lower. Chaikin money flow has been oscillating between bullish and bearish, regaining the long-term trend line, which is still declining. I don't see a reason to get involved in this stock. Not right now, anyway. The idea is auto-generated. We can always add it to a bullish watch list and see if the stock begins to outperform. But right now, as an underperformer and in this kind of choppy market, I don't have any interest in getting involved on the bullish side of the trade in PJT Partners. All right, sector tracker. Let's take a look at how the sectors have been moving over the last 5 days. A lot of red, as you would imagine, but it's still a very defensive feel at the top of the list. Utilities are positive over the past 5 days. That's lower yields and defensive positioning. Real estate is only down slightly. That's lower yields and defensive positioning. Staples are outperforming. That's defensive positioning. Now, technology had a big day 2 days ago, but now giving some back. Still earns at a spot near the top of the list. Healthcare, obviously defensive in nature. Middle of the road, discretionary, comms, and industrials. Materials, energy, and financials at the bottom of the list. Energy has been a perennial underperformer. We've been bearish. We remain bearish. Financials obviously going to be under a lot of pressure with yields falling. And there'll be a lot of focus on discretionary here today with the report out of Walmart. Walmart actually trading higher following their earnings announcement, which came in better than expected. However, Macy's and Tapestry trying to kind of painting a different story, and I just think it's interesting that Walmart, it's kind of a lower end retailer, right? So the fact that they're doing well, while names like Macy's and Tapestry are not doing as well, that kind of paints a picture of the environment right now. Our industry in focus today, speaking of, is retail services. Over the past 6 months, it's been an underperformer. It's underperformed by nearly 16%, and its power bar ratio, which measures future potential, is very weak, 38 bears to 8 bulls. It's currently ranked number 19 of 21 subsectors, moving down 1 slot over the past week. So names like Dollar Tree, Camping World, and Grubhub are certainly names that you want to avoid, all with bearish Chaikin power gauge ratings. And here's the ETF itself, the XRT, the retail ETF, has a bearish power gauge ETF rating. It's been underperforming the market since last October. Chaikin money flow is bearish. Fund is below a declining long-term trend line. Now, we've had a bearish view on this group for a long time. We continue with that view. Again, we just touched some of the highlights. Walmart's positive, but what kind of signal does that send about the current environment? Money flow bearish, just a group that we want to continue to avoid. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers, and this is a first for me. In the 16 months that I have been hosting this show, I've never seen only 3 names on the gainer side of the board, but that's the current market environment. So let's go through them. Newmont up 82 basis points. Massive outperformer yesterday on continued strength in gold. VTR, didn't see any real news there. Stock up 20 basis points. And EVRG up 5 basis points on the day, actually ticked at a 52-week high yesterday. On the loser side of the board, Macy's. Macy's disappoints. Stock down 13%. What does that do? That takes Kohl's and Nordstrom down with it, both down more than 10% on the day. XEC down 9%. Didn't see any real news to drive that one lower on the day. And Viacom, a day after the merger, between Viacom and CBS, a lot of moving parts, a lot of analysts changing their ratings. Viacom down 8.5% on the day, but very much now, for all intents and purposes, a special situation. So let's start to get into it. The yield curve inverted. Now what? All right. It was headline news. I was watching the local news last night and it made that addition as well. So the fact that the yield curve inverted and the potential signal that it sends has extended beyond the business media. But let's put things in perspective. And what we're looking at here is a chart of the S&P 500 going back to the 1970s. And the red lines indicate initial inversions. So what I did here is I looked for 210 inversions and then eliminated any inversions that happened within the ensuing 52 weeks to kind of give us a clearer picture of how does the market tend to react over the next year after one of these initial inversions. So 9 inversions, admittedly not a big sample size, but this is the type of data that we have here. On average, over the next 52 weeks, the market is up 10.95%. That's a median return. So after that initial inversion, the market tends to be up nearly 11% on a median basis on average. Now, the last 5 inversions have preceded a recession. So we're not going to sit here and stick our hands in the sand, heads in the sand and whistle past the graveyard, right? It's something that we do want to pay attention to, but again, perspective is in order. Following the last 5 inversions, the average time to recession, and it's an average, it doesn't have to play out that way, but the average time to a recession is 22 months. And additionally, after the last 5 inversions, again, the average time to a market top is 18 months. So when people say, the market's forward-looking, it is forward-looking, right? Market topped 4 months ahead of the onset of the recession on average. Again, it doesn't have to play out this way. It could be sooner, it could be later, but just a little bit of perspective. Go past the headlines, ask these type of questions. Well, how does the market perform? What does it really mean? How soon does a recession generally begin? If you start asking these questions, you start to get away from the headline gripping fear and begin to institute more of a process. On Thursdays, we look at market breadth. And listen, the market breadth has deteriorated with the market. There's no doubt about that. But there are some positives here that, should they hold in the near term, could be encouraging for a base building process. And one of those is the advanced decline line holding the May breakout, right? It broke out through the May highs back, in late May, ahead of the market, by the way. Now it's rolled over with the market, but it hasn't broken back below yet. The index is broken below, but the advanced decline line has not broken below. That's an encouraging sign as far as we're concerned. Does it have to play out that way? No, this could deteriorate very quickly, obviously, but again, start to look at the bullet points, start to take the data, start to look at what's happening. Sentiment is deeply oversold. Breadth is weakened, but it hasn't completely broken down to the extent that you would think it would, given the headlines and given the fast move lower in the market. Additionally, I would highlight the fact that the percentage of stocks making 20-day lows, actually, remember a couple of weeks ago, we were talking about the percentage of stocks making 20-day highs, rather, giving us a negative divergence. Well, now there's actually a small positive divergence with the recent low in price. So just something to keep an eye on. Would I go all in based on this? Absolutely not. But it is something to keep in mind, something to keep an eye on, especially with the market testing support. If the market can hold support at that 200-day, at the 2,800 level, then you can start to point to these breadth metrics and say, okay, maybe we can start putting some money back to work. Treasuries rise, pushing rates lower. Here what we're looking at is longer-term treasuries. This is the TLT, the iShares 20-year plus treasury bond ETF, and you can see yesterday gapping to a new all-time high above the 200-day moving average. And what's interesting to me is that it's now outperforming relative to stocks. So treasuries are outperforming equities across a couple different time frames. However, take a look here. We are overbought in the near term, right? So I'm not going to advocate for chasing TLT. But what's interesting to me, remember what we talk about with the RSI, right? How it tends to shift. And in a strong uptrend, it never gets oversold. So if your plan is to wait for an oversold condition to get involved in treasuries, you've missed it. You've absolutely missed it. Since breaking above the 200-day moving average in a move that was confirmed by momentum, if you were waiting for RSI to hit 30, you've missed the move. Notice how it routinely becomes overbought, doesn't become oversold. So just something to keep in mind when you're using these indicators. These indicators have personalities, and the ones that you choose to use, it's important to understand the personalities of those indicators. And with yields pushing lower, I think dividend achievers are outperforming, and a good place to maybe put some money for defensive positioning. The Invesco Dividend Achievers ETF, ticker symbol PFM, still moving higher above the 200-day moving average and outperforming relative to the SPY. So with yields pushing lower, dividend stocks have the opportunity to outperform, and that is playing out. That's going to wrap it for today. Check out my market survival guide, ChaikinAnalytics.com/survival-guide, where we highlight ideas. We've been bullish treasuries. We've been bullish gold for a while now. Head over to the site and check it out. I will be back here tomorrow. Have a great day.